right, we're having kind of an odd start to the trading method. Generally, things are down. We had some disappointing economic data to kind of fuel that. Oil prices are down on concerns that maybe OPEC is wobbling on its supply discipline. But largely, global growth scares kind of back front and center, coupled with the fact that we're not sure that the Fed is going to cut rates. And within all of that, the meme rally is rearing its head again. Kind of an odd day. There was also a trading glitch that saw Berkshire down 99% and GameStop up. Well, it was up as much as 90%, I should say, now up only 30%. Let's get perspective on all of this. We've got Bloomberg's Abigail Doolittle and Sahak Manuelian, head trader at Wedbush, joining us. Abigail, let's start with you. The meme rally back. It was a quick fade, right, a couple weeks ago when Keith Gill initially posted, but he posted this time and it had a little bit more heft behind it. Tell us why.
Yeah, it's really pretty wild what happened last night around 8 p.m. on Reddit. Keith Gill posted a meme essentially saying that he had taken on a new position in GameStop, 5 million shares worth about 116 million. If this is true, he's among the 5 largest shareholders. And I say if it's true because it hasn't been verified. In addition, there's a large call position there. I did speak to Steve Sosnick over at Interactive Brokers, and he said that the open interest on that particular call is large and could in fact be the case that he does have that position. But what makes it so interesting, I'm looking at a chart right in front of me. You're talking about some of these swings, not for the faint of heart. In April, this was a $10 stock. Then it was up 550% to nearly 70% on, I think at that point, Keith Gill, Roaring Kitty on X, had posted something along the lines of a gamer leaning forward, suggesting that he was getting ready to do something on GameStop. I should also mention he yesterday posted an Uno card, the reverse card, suggesting that it was going to reverse the direction, because after that 500% rally higher, it then was down 72%. The reverse higher on this news, up 129%, not for the faint of heart. A lot of money is being lost and sold here. It's, of course, a great story for the media, but there are real traders there, some of them doing very well and some less so.
But it's so wild, right? You think about the fundamentals of investing, I don't think you find in your CFA textbooks. And when a meme is about an Uno card, you know what I mean? It's just so, and to see these kind of price swings. But to your point, I mean, those are, if they're true, those are hundreds of millions of dollars that he has staked on a very low initial investment.
On a very low initial investment, but we don't know how long he's holding them. He could have bought and then sold. I mean, he's, based on my knowledge, he's under no restriction here whatsoever. You know, it's what it really strikes is the idea of confidence that, you know, he was the one that started the whole meme rally back in 2021 on Reddit with the meme traders. And I should mention today, we also have AMC, the likes of some of these other meme stocks higher. The fundamentals, to your point, there really aren't any that are so encouraging. I mean, this is, you know, an interesting business, but you could argue that it's a business that's going to have a hard time going forward. They sell games out of bricks and mortars as opposed to digital. Big competition there for sure. But GameStop last week did take advantage of the rally, even though it had come back from that $70 high by capitalizing and raising roughly $933 million. So GameStop, in fact, Michael Pachter over at Wedbush, he's saying that they could do this again. So, you know, it's interesting because these rallies that are influenced by these traders over the internet, they have real consequences both to the upside, but I will tell you, there are some people at home trying to trade this and they are getting hurt in a big way.
All right, Abigail, that's a really good point. Abigail Doolittle joining us from Bloomberg. Let's bring in Sahak Manuelian, head of trading at Wedbush. And Abigail was referencing Michael Pachter, who's also at Wedbush, Sahak. But, you know, he often talks about fundamentals, and you must see this on the desk, that that's maybe not what's driving these particular basket of stocks.
Yeah, definitely not, Amber. We've got an underperform rating on GameStop here and really continue to expect the mix of software sales to continue to shift to digital and away from physical. So we've been quite negative on the stock for a while now, but that doesn't seem to matter with Keith Gill or Roaring Kitty having so much influence on this stock and also spill over into some of these other meme names.
It's interesting that it has life, though, on a day where the tape feels pretty negative and pretty defensive. And it's been a while since we've talked about like global growth scares because the market just has been so resilient. But, you know, that it's such a contrast. The meme rally that we're seeing today is against a backdrop, Sahak, that looks shakier, that looks more defensive.
Yeah, I would agree with that. The May manufacturing ISM this morning came in lower, and it really speaks to investors, I think, trying to decide whether these lower rates can offset some of the EPS headwinds associated with cooling growth and inflation. So we'll see how that works its way out. But the meme stocks or GameStop and some of these others really disconnected from what's going on in the broader market.
I think it's a question about is it's the last gasping of breath for a bull market that maybe is due for a bit of consolidation. I'm sure you've seen this, but there's been a lot of discussion about breadth. There's different ways to measure it, but if you look at the equal weight S&P relative to the market weight S&P, it is underperforming the most since the financial crisis, right? And all that really says is that the big stocks are the one that's taking us higher. And anytime, Sahak, you reference anything back to 2009, you automatically think it's a bad thing. So from your perspective, are you seeing signs of weakness? Does this breadth, does the underperformance of the equal weight bother you?
Yeah, well, I think we're definitely seeing signs of underperformance amongst the broader market. Both technically and fundamentally. Fundamentally, we saw so many of these tech companies just recently report earnings, and within those earnings, though the earnings individually weren't that bad, there was so much froth, if you will, built into some of these tech stocks. They really took you know the lack of guidance really bad and started to really get hit. So we've seen some of these tech stocks really get hit over the last week and a half or so. And we're certainly seeing a lot of rotation under the surface. Now, breadth, on the other hand, you know, the equal weight has been continuing to underperform the broader market cap. And that probably continues until we actually see rates start to come down a little bit. And until that happens, I think that we still have a lot of these tech stocks, these large cap tech stocks, really act as somewhat of a safety trade as well in here.
And I guess the question is which one, because like a Salesforce, for example, got absolutely run over again on the outlook. So is it within tech, do you just have to hug super close to that AI theme? Because it's clear that those dollars maybe are coming out of, you know, software budgets that would typically go to a Salesforce.
Yeah, that's a good point, Amber. Those budgeting dollars are certainly coming out of software stocks. AI is garnering more and more attention, and to that point, we see the relative spread between the semiconductor index or the SOX and software stocks about as wide as it's been year to date. I think that probably continues to play out that way until some of these software names start to trade to more reasonable or certainly cheaper levels than they're currently at.
And yet, I mean, I'm looking at the best performing sectors in May: tech, utilities, telecom, healthcare, real estate. That's a pretty defensive tilt. And I'm wondering, is that the flavor that you're getting across the trading desk? Is there more caution? Is it just a mean reversion trade that they got so sold off, so now people are willing to nip away? How should we interpret what looks like a pretty defensive rally over the last month?
Yeah, and it's only been over the last month that we've seen some of this defensive rotation under the surface, but certainly some of these defensives are making more and more headway. One can take a look at the healthcare complex today. It's the only S&P sector up today, while everything else is lower. But to that end, certainly communication services, and within that group, there's a few names that are really moving that whole group to the upside. Utilities have certainly been acting better. healthcare a little bit better as well just recently. And we think that a lot of this sector rotation continues to play itself out, and especially going into the second half of the year and going into this election coming up in November, I think we see more of a safety trade, and certainly see more dollars come out of the early leadership that we saw in some of the large cap tech funds as those become somewhat of a source of funds for investors.